look to build up on understanding what is it that has taken place in the last decade and key lessons that we need to learn. It's obvious that we need to go back to the individuals who have been formidable players on the ground. And this actually calls for our first panel discussion, ladies and gentlemen, which takes a look at understanding the evolution of the real estate investment and development environment across the African continent. What have been some of the nuances? What have been some of the more significant failures? English ran away with me there. And of course, understanding some opportunities that were actually so ripe and made for a significant growth opportunities for the companies who participated. So to give us some insight there, we speak to leaders within this particular space. This is a panel discussion which will run for the next 35 to 40 minutes. We do understand that time is of the essence, and it will be moderated by Tom Mandi. He's the head of international capital for Sub-Saharan Africa at JLL, and he'll be joined on stage by the following panelists. Nii Adeleye, Head of Real Estate Finance for Africa Regions at Standard Bank Group. Thomas Riley, Managing Director for Growth Point Investec African Properties in the UK. Kevin Teruven Gadum, who is the Real Estate Advisor for Mauritius, as well as Adam Nesbet, who makes his way back onto stage as the Head of Investment for Grit, based in Mauritius. Please warmly welcome our panelists and the moderator back on stage. There will also be an opportunity for you to interact through questions and answers, so at any time, if you do have them, our moderator, Tom Mandi, will make his way to the floor and ask you to raise your questions. But for the moment, let's get excited, let's get ready to learn, and most importantly, be inspired by some of the lessons that will be shared. A warm welcome to our panelists and Tom Mandi.
Thanks very much for the introduction. We've got a great panel this year. I mean, the panel's always very good here, but this is an excellent panel with a lot of interesting stories, a huge amount of anecdotal experience working in these markets over the last 10 years, covering West Africa in particular, but actually all of Africa as well. So the aim of this discussion, which will run for 35 to 40 minutes, depending how we get on, with some Q&A, is to explore the different strategies, the experiences we've seen in these markets. It's my firm belief as someone who's perennially optimistic about Africa, as well as emerging markets in general, but Africa in particular at this stage, that the markets are starting to turn. I mean, I said that last year, and I said it the year before. This year, I really believe it. I think I was lining up for this year really being the point of inflection. But this year, we actually have evidence of activity. We have evidence of transactions. We have evidence of groups, and not just Grit, expanding. We have evidence of rotation. We have some of the traditional players being replaced by some of the new players. So I think it is an opportunity to talk about that story. At the same time, clearly, the story that we see in Sub-Saharan Africa, or Africa, is quite a different one to the cycle that we've seen in Europe, the US, and Asia Pacific, and in particular emerging Europe. So I think we want to take this opportunity also to explore the value proposition for Sub-Saharan Africa. It's not been an easy ride. I would posit that it has been a bit of an easy ride in Europe. It certainly hasn't been. We've had a very compressed cycle here. I suppose it's been a challenge. So those are some of the points we want to explore. Some of the strategies as well which are being deployed, focus on particular countries, and what the vision is for the future. Finally, I would probably also make the point that one of the areas that's also important is the way that capital is behaving, who's funding this expansion, how have the sources of capital changed? Because it's quite a sea change from where we would have been 5 years or so when the market looked very different. So everyone has very different experiences. I think the first question really that I wanted to pose is to look back a little bit, because there's so much anecdotal experience from the panelists, and the experiences they've had in these markets, is what has changed in terms of doing business in these markets over the last decade. How have these markets changed in terms of professionalism, in terms of service providers, in terms of stock, in terms of players, in terms of ease of doing business. I would love to press, I'm actually going to press Tom Riley first, because he's been in these markets for a long time doing various different things under various different guises. You know, maybe you could give us your experiences over the last 10 years, where we are now compared to where we were.
Yeah, thanks, Tom. Not sure we got enough time for all of that, but I think
Only
if we
the good experiences.
Yeah. So I think if we, if I have to sit here and look back over the last decade or so, we were basically at that stage, I'd moved out of a world of financial markets into running the Sanlam real estate business, and then as a pet project basically looked at starting up an African fund. And at that stage, no one was looking at Africa. It was a fledgling, sort of thought really that we had at that stage. And ultimately I decided to, get out of the corporate industry, so to speak, and out of that rat race into something a bit more entrepreneurial. And ourselves at that point, together with Atterbury, bought Accra Mall. That was our first transaction. And, in terms of pricing, there were no benchmarks. We didn't really have any managers on the ground. It was very much untested, uncharted territory, so pricing was also, it was a thumbs up really at that point in time as to how one priced the transaction. Getting a valuation was even more subjective. But I think if you look over the period, there've been a number of transactions I think that worked. There've been others that far from worked. So it's very much been a learning curve. But I think, to speak to the various components that go into managing these assets, to acquiring them, the complexities of dealing in some of these foreign markets, I think it's come a long way. Is it perfect, and is it akin to what I would see in the UK or elsewhere? The answer is no. But it's come an enormous journey since then. And I think if one looks at the amount of transactions that have happened, I think funds coming to the market have without doubt blazed a trail. And I think the management aspects, I think if we look at the likes of Brol, who involved across the number of the countries that we're involved in, Knight Frank are there, JLL are there, etc. And I think the levels of skills involved in managing these assets have improved tremendously. I think our first few years were spent really holding hands, and I think that has changed. So the businesses are far more adept to management, and the valuation side of things as well has come a long way. I think a lot of the time it's still very much a black box exercise, but there are a few valuers out there who, in terms of their methodologies, have really come a long way. So I think we're getting there, but it's been tumultuous, and I don't think we've reached that point where I can say it's an efficient market and something that we can sort of hang up our boots and say the work's done.
Thanks. I would say that was a great opportunity for me to plug JLL's valuation team and how much we enjoy competing with Brol in this market. Kevin, at the far end, looking at this point about the cycle, because you've obviously come through the cycle in your experiences with at Africa. How have you found that volatility through this cycle? I made the point when we were talking a little bit earlier that the African experience has been completely different to the European experience. It's not easy money, very compressed, very volatile. How have you found navigating through those cycles?
I guess when you look at Africa, obviously you've got cycles that happen every couple of years for a number of reasons. And I think it's very important to go back in time and to understand where we came from. So if you sort of go back 2005-ish, this is when Actis actually set up the first fund, and I was lucky to be part of that first wave. And then eventually 5 years later or 6 years later, a number of investors came in, that second wave. A lot of South African investors came in, etc. And then we saw in that phase from 2010 to 14, 15, lots of construction was happening in key markets, Lagos, Accra, Nairobi. Those were the three. And then you had the peripheral, sort of Maputo, and then people started looking at Abidjan, etc. And then we got hit with, obviously, the downturn of commodity prices, which, we saw for the last couple of years. Rentals have gone down. A number of investors who are currently sitting with assets who are not able to exit or haven't been able to exit, etc. So I think if you look at that, you say, where are we seriously? Was it a bubble? Have we burst that bubble? Are we back on track? What does it mean to be on track? And I think what we should do, and I said this 3 years ago, I said, we need to analyze data and really tell ourselves, what are we investing in? What are the macros as well behind? And what kind of values? And I think that's what investors are looking for. A couple of things on my side is we keep forgetting that irrespective of whether you're buying 10,000 squares in Maputo or Lagos or Mauritius, those properties will be influenced by the macroeconomics. That's the reality. And it's interesting, over the last 10 years that we go to the API, et cetera, we all talk about the brick and mortar, but we keep forgetting to talk about the macros. And the issue we have in multiple markets is our macros will always pull us back, basically, in that cycle. What I mean by that is we're working in markets where you've got at least 2 or 3 deficits, fiscal, balance of payments, and budget deficits. So you can do a lot of hard work, and then 3 or 4 years later, you see yourself being pulled by exchange depreciation. That's the reality. I think the biggest issue we've got today in Africa is not about property management. It's not about building or buying. Buying, everybody can buy. I'm sure if you give everybody $1 billion, they'll probably be able to buy something tomorrow. The issue today going forward is we are stuck in that macroeconomics where basically we pull back by currency devaluation. And that's the thing that we need to say to ourselves, how do we tackle that? So we're seeing in some of the markets, people are moving from US dollar to local currency. So is that the way forward? This is something which happened in Asia. Are we going to see that happening in Africa? Or are we going to have a hybrid? So to conclude on that, I think for me, the next 2 years, I don't think we're going to be back to 2014 or 2013. I think we're going to be slightly stable going forward. I can't see double-digit growth. I think it's more single-digit. Are we going to have another 25% whack? Potentially it could happen, depending on what happens in the global economy. So if investors pull out money, if there's a global recession, we might be hit. But that's something which can happen, and we'll have to deal with it. So my conclusion on that is 2014 was the peak bubble, and I think we should forget that. Let's be realistic where we are. And you know what? If we've got 5% growth, 2% growth in value, we're doing fine. Let's stick to that.
Okay, so there's a few points there, Kevin. I definitely, I think we can pick up on. I'd like to, I think before I do that, particularly the relative value proposition of sub-Saharan African assets, where you've got relatively modest growth or you've got a narrow yield spread. I would like to touch on the currency point, which I think has 2 forms. One is to go to Niamh on the debt side. One of the issues that we have is how risk is priced in these markets and how funding can take into account those risks. And indeed, whether or not it's fair to say the markets can actually operate on a local currency basis, because as far as international capital is concerned, those equations don't work. How are you experiencing it? Because you're the backers of a lot of these projects and a lot of these developments and a lot of these acquisitions. From the debt point of view, is it fair to say there's a currency move? And then the second question is, how do we price volatility in these markets?
Thanks. I think from my experience, the sustainability of the market is one of the things that, from a real estate funding perspective, is one of the things that it's kind of critical to us. In different markets, we've looked at the possibilities of looking at of funding in local currency, and you've tried that in a few bits. The challenge you faced with speaking to clients or speaking to sort of investors in the market is that the local currency rates are both high and volatile in many of the markets. And the combination of the two just kind of doesn't work for real estate. So with that mindset, you've kind of had to sort of focus on still hard currency funding with counterparts that have the balance sheet and depth of pocket to sort of adjust to some of the volatilities that would happen or that could happen. Obviously, from our perspective, we take that a lot more seriously and more critically when we're sizing the debt, or sizing the debt that is affordable to an asset or to a portfolio for that matter. These days, I mean, I think we're back to the old norm that cash is king. We place greater reliance on the actual cash that the asset is spitting out. You know, the ability to sort of just take a view around leasing and trading, you've got to temper that with the arrears and essentially just determine what cash the asset can generate, and then fund on that basis, and we sort of incorporate into it structures that hopefully address the potential volatility, or look at or establish what is sort of a base and what is sustainable. We've historically argued about sort of high equity sort of injections into deals in the Africa space, but when you sort of rebase rents and valuations fall off, that equity sort of cushion is somewhat eroded. So that theory, or the basis that you sort of enter the deals with in terms of what your equity levels are, somewhat challenged. So from our view, we think, to Kevin's point, the macros are important. We've got to get to the point where local capital mobilization is what is used, but I think we're quite a ways from there. The local capital will come in the form of either equity, pulling on pension funds and there's quite a bit of that actually in the markets, and that has accumulated over the years and have very little exposure to real estate, but also perhaps those sort of capital sources start to look at, over and above equity, debt products that can be sort of both reasonably priced and stable.
I think there's a session coming up on exactly on that, on the ability of local liquidity to de-risk assets over the long term and whether enough is being done. So I won't press on that, but I think it's a point well made. But are you getting to the point though that the tolerance for doing anything to get occupancy up, even if you have to accept a little bit of a local currency lease, is starting to change and the market's starting to pick up a little bit? Certainly our experiences of the markets we're in, we're starting to see occupancy improving, tentatively rent starting to pick up. Do you see some changes now from your side?
Yeah, there's a fair bit of change. I think what you tend to find is still there's always a reversion to rebase that rent, whether it's collected in local currency or otherwise, into some sort of a dollar form. And in our minds, if you're going to, that ability to sort of convert has to be there. Otherwise, the fundamentals around lending in hard currency becomes completely eroded. It is acceptable that you would have a mix of it, or a combination of it, to try to build some level of sustainability into that structure. And I guess you also have to look at it on the different asset classes. Retail is a little bit more sort of nuanced. Commercial offices with sort of multinational tenants tend to be a little bit more resilient. Similarly, industrial could also sort of follow the same path because of the kind of tenant base that they have. So it sort of varies for the different asset classes and the strength of the underlying that sort of pushes through in there.
So maybe Adam, on this point about currencies, the central premise to Grit's expansion has always been the strength of covenant, the ability to source US dollar leases, and perhaps the arbitrage between perception of risk and reality of risk. And although I appreciate, in 6 months you've probably coming into this phase when the markets are starting to pick up a little bit, but Grit were buying through the cycle. So how do you see it now, and what's the lay of the land when you're going into markets and you're trying to expand across sub-Saharan Africa, and you're trying to find these strong covenants? How do you find the product to be able to do that? And it's a tight market.
Yeah, I think Tom, from my side, I think it's difficult to throw a blanket over all countries. I think is the first point that I would make. I think the macro discussion is an interesting one because it's different in each case. Africa doesn't move together in the different countries. So you look at Ghana versus Zambia, they're in different places of their cycle, in my view. And I think in terms of the tenant-driven approach, I think it's about being selective because the funding discussion is always a difficult one. I think we are only as good as the bankability of the deals that we're looking to do. The counterparty is always key. The currency of the lease is always key. The lease period is always key. How we mitigate that risk of if there is an element of local currency, or if the local currency is pegged to the dollar, how quickly can we convert that money to pay dollar debt back? So it's about giving ourselves comfort and giving the lenders comfort. I think especially where the markets are at, even more so, one needs to be selective on the deals that it gets into. I think, from a Grit perspective, the strategy has been historically to, not look for assets that are necessarily undervalued, but rather to focus on counterparty, to pay value for those assets and let them mature over time. And I think that's really worked. The group's focus has been on the tenant itself rather than chasing a development yield, taking a risk in that regard, in order to get to a size where it's now at a position where it can potentially look to do some of those things. But the investment strategy remains the same. I don't know if that answers the question.
Yeah, I think there's, clearly, sitting next to Tom and with the GAP strategy, there's clearly capital in this market that's expanding, and with quite different strategies. I think the Grit strategy is to pay for yield. I think the GAP strategy is, maybe Thomas, you can allude to the GAP strategy in contrast to the Grit strategy, where there's assets that are rotating. What's your value proposition if the Grit value proposition is to buy covenant? How do you approach that? Especially, and maybe you could refer to some of the acquisitions you've made in the pipeline that you see going forward.
Yeah, I think, our propositions, and I think more than the proposition, the strategy really is quite different. Adam, you mentioned a few times in your earlier speech, in the opening welcome address, as well as now, that it's very much a tenant-followed strategy. And clearly, tenants are incredibly important. We know that as much as anyone. But at the end of the day, you need to ensure that a property is rentable post a lease or a specific tenant. So, in our view, it doesn't really help us to go and buy whether it's a small office asset or a logistics asset or something in the middle of nowhere. Because at the end of the day, although you may have a wonderful tenant leasing that space, when that lease comes to an end and you potentially run the risk of a tenant moving out or some other event that terminates that lease, you're stuck with an asset that means nothing, right? So for us, it's about very specifically targeting cities that are growing. It's not about targeting assets in general outlying areas. So, that's not what we're trying to do. We're trying to more than just target cities again and just have a single asset as an example in a specific city. It's about being relevant in that city. So, there's no way that we can influence the market in take Accra as an example, with just one asset. One has to have enough weight in that city to be able to influence the tenant demand, to be able to get some sort of synergies in terms of managing and effectively managing those assets. So, for us, it's about very specific cities, and I mean, there are 4 or 5 of them, on our hand that we're going to focus on, and for the next few years, to be honest, that's probably it. So you're not going to find us in a whole, never mind, I mean, Grit's in 7 countries, as an example, and far more cities. You won't find us doing that, so very different strategies. And I think as well in terms of the focus, and I think, that's something you mentioned earlier as well. I think, we are really office and retail. To the extent we can find logistics, we'll look at that. But it's predominantly office and retail. That's it. No residential, no hospitality. We are specialists in terms of what we do, and we aim to execute that well, as opposed to being, a bit more of a jack of all trades.
So maybe then, as the 2 players that are in the market, and then I'm going to switch to Kevin on expectations. But as the 2 players that are in the market that have been raising capital or look to raise capital, and I think arguably have been successful and very successful in doing so, flying the flag slightly for African expansion. Do you see? Maybe I'll ask Adam first, and then Tom, I'll come back to you. Do you see this capital source kind of evolving? We've gone from the stage, and obviously, Tom, you've been picking up assets, from in Manda Hills and in Achimoto, from sort of the old sources of capital, or traditionally the older sources of capital. Do you see a rotation into Europe and the US, sort of more new sources of capital, perhaps with slightly different expectations of what they should be getting out of Africa, a longer-term view, perhaps, or slightly more realistic expectations of IRR? Maybe Adam, I'll talk to you first, because Grit were very high profile in this last year, and you've obviously got a expansive pipeline. So I'm assuming this is an ongoing discussion for Grit. Do you see that rotation happening?
Yeah, I think so. Tom, I think Bronwyn can probably answer this question a lot better than I can. But this is why she's not here today. She's out there on a roadshow, doing exactly that. And the signs are definitely very positive. She, from the feedback that has been forthcoming since Grit's listing in London, is one that it opens up completely different capital markets to the group. The likelihood of that money flowing into African investments through the Grit structure is now, there's a vehicle in which it can do that. And we're seeing that appetite for sure. I think to answer your second question, it doesn't come easy. There is still a question mark around Africa, and until the track record of Africa goes through a number of cycles where players like Growthpoint, Investec, Grit, and a lot of the other players in the room show that track record over a period of time, that capital that's sitting there is not going to always have the confidence that it needs to flow into these structures. But this process is necessary and so important to bring that capital into Africa. But they seek a higher return. So we have to show those investors much more than you would normally need to in investing into an African idea. So this roadshow type discussion where you have to educate people on Africa, on African investment, on a Grit strategy, a Growthpoint Investec strategy, which is different. It's a discussion that has to be had over and over in order to get that capital here. I think it's a very important process for everyone in the room for that to be successful, not just for Grit's sake, but in unlocking Africa and unlocking capital into these markets. It's an important time. I think the next sort of 5 years of that taking place, and certainly it's not sustainable. It's not something that can happen into the long term. It needs to change at a point in time, and I think, but it's been very effective for Grit to date.
So, Kevin, afterwards I'm going to go to you on this idea of expectations of IRR, but very quickly, Tom, would you concur that the market is shifting in terms of where capital is coming from and those expectations of the returns that should be generated?
Yeah, I would actually. I mean, but I think, you know, with a few caveats perhaps. So I think if one looks at the sources of capital, you know, when we hit the roads back with the Sanlam Fund back in 2011, 2012, you know, we had aspirations of the US coming in, aspirations of Europe coming in, and none of that really came to pass, right? So it was really a largely South African backed story. If I look at the last few years, and I mean, we clearly not by design, but we chose probably the most difficult cyclical period to try and raise our capital. So, you know, someone said to me last night at a function, NIE was hosting that, you know, Tom, you've become an overnight success. It only took 4 years, you know, so it's been exceptionally tough to get that money together. And what we've noticed is that the funds are starting to come from very different places. So I think there are a few common themes. You know, we originally thought when we started out, you know, our fundraising process some time ago that it would be largely sourced from the DFIs. So, you know, obviously the IFC are a major backer and partner of ours in what we're doing. But we had expected the DFIs en masse to support what we're doing. And, you know, obviously there's a huge element from the DFIs in terms of impact, in terms of, you know, getting their sort of criteria ticked. And the reality is that they didn't see ourselves as more of a core fund, you know, essentially possibly a bit of development work that we'll undertake, but largely, you know, buying existing income earning assets and trying to aggregate that market, really with the aim not so much of impact in terms of underlying developmental real estate, but impact in terms of trying to catalyze the real estate markets as far as the capital markets of real estate, which we believe is hugely impactful. But nonetheless, that market hasn't really entered the space to date. I'll get back to that in a second. But it's largely been pension fund driven. So I think it's long-term money just coming into the markets. Those are the bulk of our backers in any event, and that's a good thing. I mean, it's stable money, it's long-term money, it's money which has got deep pockets. So we're quite excited about that. And interestingly, that's, you know, we've seen a lot of that or interest from Europe. It's you know, the bulk of our funders are not South African, as an example. So US is also showing strong interest, and interestingly, of late now, the DFIs have started to knock on the door. And that's on the back, though, from a comparative perspective. The question you were asking earlier is that private equity generally, you know, which has taken a lot of capital across the continent as opposed to real estate generally, has not been performing, right? So if you look at average PE returns, you know, in a lot of these PE-focused funds across Africa, the returns have been 0 or marginally above that, and in many cases not even above. So it's been really quite horrendous, and I think a lot of the DFIs are now looking to, you know, stories like ours as a potential vehicle for deployment for them. You know, so it is changing, and I think if I look forward, I think, you know, the amount of funds that we're seeing out of Europe is going to pick up. I think the Middle East is looking very strong. You know, we have some a lot of discussions going on there, and a lot of funds that we're seeing out of the Middle East, and the US as well. So I think it's shifted without doubt.
Okay, and so maybe then going on to Kevin, what do you think? You know, taking a step back from it, what do you think, therefore, is a realistic value proposition for sub-Saharan African or African portfolios in an environment where there has to be a relative trade? It could either be the Eurobond market, which in Africa has been way hotter than the real estate market, let's face it, or it could be, you know, the Polish yield spread, which, you know, Redefine have taken advantage of. You know, do you think, so I suppose the two-part question, do you think expectations of IRR have changed? And what is a realistic value proposition for the sub-Saharan African real estate space?
I think it's if you're sitting in New York, London, or Beijing, or whatever it is, etc., one thing we keep forgetting is people have got the ability to invest anywhere in the world. Even South Africans, for example, we've seen how they've poured money into Central Europe and Eastern Europe. Most of the guys are actually playing in that territory. That's a fact. It's also interesting to see how we started this panel saying, Africa is the place to be, and number of countries are growing, etc. And then, 5 minutes later, we moved to how not easy it is to play in this market, and then we wrap up with saying, by the way, there are not 100 investors queuing up there. It's hard to raise money. That's a fact. It's hard to raise money, and I think we need to be truthful to ourselves. Is why is it hard? Investors are not stupid. I mean, whoever sits in New York, London, etc., they know what's happening, and they've got a fantastic visibility. So I think we need to be factual about what are the extent of increased valuation, of the assets. What are the problematics that we have? And I said to you before, currency for me is ongoing. I think in my lifetime, if we have this conference 20 years from now, I think it's going to be still around, that currency devaluation, which we need to deal with. And then also in terms of the liquidity of the market, so people want to exit. We know we've had a couple of real estate funds that have listed in Mauritius or elsewhere, etc. But when you look at trade, it's $3,000 of trades every second day. That's nothing. It's very thin. So I think when an investor look at all these, they do question, if I'm putting my money in, it's so hard work, and I'm not getting, you mentioned, people are looking for higher returns. They're not getting in. I mean, the last 3 years, I've invested in Portugal, and I made more money in Portugal. Simple as that. So when you think about it, I do understand why South Africans have been investing in Romania and whatever, etc., and saying, hey, by the way, it's easier to make money there. So I'm not saying that, we cannot canalize investments to Africa. We can. I think what we need to do going forward is to be rational about our expectations, to be truthful about valuation, and also to be truthful about the problems. The problems are not going to disappear over the next 5 years, and that is reflected if you look at those who are listed. You will see there's a reason why they've lost 30% to 50% value on the stock exchange. I mean, the stock exchange is a place where you can actually see demand and supply, and reflects the share price and reflects the underlying value of your portfolio. So there must be a reason why. So I think we need to say, okay, where are we going to raise money? Knowing truthfully these are the issues and these are the kind of returns. So for me, if you go and promise anything beyond double digit, I think you're fooling yourself, and I think we're fooling ourselves. So I'm not saying because you're getting single digit, investors are not going to look at Africa. You've got investors who are saying, listen guys, I've invested globally, and I don't mind putting 0.0001% of my investment into Africa, which is the $50 that Tom and Adam might need when they fundraise. When you look at the investors who've been funding these deals or funding these real estate funds, etc., most of them have been investing around $25, $50 tickets, basically. Only one investor have actually put a sizable check, $500 million. That's the Qataris, Qasada. But that's a very different philosophy, different mindset of balance sheet that they've got, and deep pocket that they've got, etc. So to rationalize, I think my view is we need to get more African liquidity into this thing. If not, year in, year out, we're going to struggle to raise substantial amount of money. Grit have raised a bit of money, Tom has raised a bit of money, but I think we should have been collectively raising more, far more money. And I think that money needs to come from our own pension funds. There are lots of money in Africa, unfortunately, that's going to bail out governments. I mean, if you look at government bonds, you go to Nigeria, they just buy government bonds. It's too easy. So I think we need to canalize part of that money. Even if we get 10% of that money into these African funds, it's going to make a change going forward.
I mean, it certainly seems to be the case that if you look at European yield expectations, it is increasingly hard to find yield in emerging European economies. So the relative value of the trade in Africa has changed, I think, over the course of the last 12 months. You can't buy in Poland at 7.5% anymore. You can buy in Poland at 4.5% or 5%. And with the interest rate cycle, the cost of funding is starting to shift a little bit as well as ECB expectations pick up. So I wonder, and I want to have a specific debt question to you afterwards, but I bet to the two guys in the middle, do you think that there is a perception that actually it is hard to find, it is actually quite hard to find yield in Europe at the moment, it is hard to buy assets in a market where you can buy anything in the world? Do you think the African story actually, sort of to contrast a bit with Kevin's comments, that the African story does stand out now a little bit more than it was doing, say, 18 months ago, particularly given that assets are trading at a bit of a discount now to where they were, valuations are more realistic, and for a lot of the economies that we work in, you know, if it's Ghana or it's Ethiopia or if it's Kenya, growth is pretty robust. It's certainly pretty robust relative to European markets or emerging European markets. It's more volatile, but it's also quite robust in the short to medium term. How would you juxtapose those positions, Tom and Adam?
Yeah, I mean, it's a very difficult question to answer easily. You know, it's something that's come up quite a bit in my discussions with some of the big international houses looking to deploy capital. You know, the first comment before I chat, just on Kevin's point a moment ago, you know, about people putting in 0.01%. I mean, the reality is that if you're a big fund manager sitting in New York or London, it's simply not worth your time to put in $20 or $30 million or even once or $50 million into a fund. You know, these guys are dealing with billions and billions and billions of assets under management, and it's, you know, to put in that it's just too small. You know, so one needs an aggregation to take place in this market where you have some big enough funds that can actually start attracting, you know, that capital, where they, you know, because a typical international fund is not going to put more than 20% or take up 20% of a fund. So, you know, if they're going to put in, say, $100 million, by definition, you need to be $500 million big to take that capital. That's the first point. The second point, just on relative returns, I mean, you know, you still can get 6.5s, even a 7 in Romania, in Poland. I mean, Growthpoint is involved there. I mean, those markets are trading there or thereabouts in the office space, as an example. You know, so, you know, and if you look at some of the more sort of emerging European markets, you know, a 7 is possible. You know, I mean, if you look at retail in the UK right now, you might even get a 7.5, to be honest. You know, so
If you get the right asset.
yeah, no, exactly.
There are challenges there as well.
There are enormous challenges, but you know that's part of the point. So if you know, the reality is that if you can get a 7 in Eastern Europe, a 7 in retail in the UK, to buy something on a 7 or an 8 in Africa is not going to fly. You know, so there's a debate as to what that liquidity premium and what that risk premium for Africa should be. And it's clearly not 1 or 2. I mean, it's more than that. So in terms of where assets should be trading in Africa, I think that, you know, historically, if you look at where a lot of the transactions have taken place over the last few years, we feel it's been quite expensive. You know, and I think that there's a reset which has come through. You know, I think the timing of ourselves coming to market. I mean, we had ample opportunity to deploy funds, you know, a year and a half ago, and we deliberately chose not to because. And we didn't know whether we were right or not, but it's turned out, I think, to be the right strategy, where the market seems to now be turning, and I think the time of execution, you know, in the last sort of 3 months has started to look like it was the right call. But I think, you know, the reality is that in Europe generally, I think, you know, there has been compression. You haven't seen compression in Africa, right? So you've still got some opportunities in sort of the 6s and 7s, as I mentioned. You have got the advantage, though, of positive leverage, and enormous positive leverage. You're going to fund yourself at 2.5%, 3% in Europe. You're not going to do that in Africa. So, but the one thing that is missing and that has also changed in this market, in the African market, is that you have, you know, you have an escalation of cash flows going forward. And I think what's happened, if you look at where rentals have come from over the last sort of 2-3 years, I mean, in Lagos, I mean, they're off easily 30-odd%, if not more. You know, when we first bought the building in Atlantic House, we had rentals of $1,200 a year, so $100 per square per month, escalating at 12% in dollars per annum, year on year. It was incredible, you know. We obviously could see through that wasn't sustainable,
Yeah.
but we probably still didn't take a big enough discount on where we traded that asset. But the reality is those escalations was probably averaged around 5 or 6%, are probably now averaging around 3. So that's been a marked change, and I think but the biggest thing is that at least with the correction is we've now hit levels which are far more sustainable. So prime office, retail, or prime office rather in Lagos, or from those astronomical levels, even a year, 2 years ago, was sort of around about $70, $80 mark, or at least that's what was being tried to be leased at. They're now 55, or thereabouts. So I think off that base and 3% escalations, I think we're in for a much more sustainable growth trajectory, and I think something that can probably hold its weight.
Nee, just a last quick question to you. When you're building your book and you're listening to these arguments, particularly from Adam, from Tom, but are you more comfortable now? Like, your book is expanding, I'd imagine, aggressively, and you're looking for these opportunities. Are you more comfortable hearing that story where actually you've got a slightly more realistic expectation of escalations, you've got yes, you've come through hard times, but are you now feeling a little bit more like this is a realistic story, we feel more confident and we're happy to lend against that?
So from our perspective, I think what we have tended to do is focus on counterparts, and look for clients that are long on the assets and long on the markets, because there would always be interruptions, whether it's the commodity prices or some other macro factor, or tenant tenant volatility, which you still have as well. The ability to have that conversation around, what's the real value, what's the real cash flow that this asset is delivering, and what's the sustainable debt it can carry, is a fundamental element in terms of how we tend to select deals that we can support. There is rationale there's a rationale in following a tenant strategy when you're looking at the multinational corporates. They're a lot more resilient, able to absorb the shocks better. There's also value in ensuring that you're buying the assets at the right price. If I think about what we're seeing in the market now, the supply of new assets kind of slowed down, and in my mind, I don't think it will pick up materially in the next, 2-3 years, maybe longer. What that does is that it gives existing operators time to consolidate and to sort of build up and ramp up as the markets sort of evolve, the markets are stable, I think, or we think, but it gives them an opportunity to ramp up. If you're in the asset at the right price, then you can sort of back that story. If the asset is delivering the cash flows, then you can back the debt story as well. And that's sort of the way we slice and dice it.
Perfect, thank you. So I know we're going to get told to get off the stage. So just final one, if you could each give me your 3 words that you would use to define what you think is going to define the market over the course of the next 10 years. Just 3 straightforward words, just quick fire, without too much thought. Kevin, how do you see it over the next 10 years?
The next 10 years.
Next 10
Okay.
years. 3 words to define it.
I think we need, I think the re-rating we had in those markets, Tom spoke about it, rentals going down. I think rentals didn't go down sufficiently enough. I think we're going to have another small re-rating, and then low growth going forward.
Adam?
Yeah, I think, Tom, for me, the big word is sustainability. So that can be across all sort of aspects. Tenant sustainability, income sustainability. That's one sort of big side of it. And I think we need to look at total returns. I think is the other one that we need to touch on. Grit has gone through an evolution of its strategy recently, which is going to see a bit of a shift in its mindset and in the way it approaches investments and its strategy. So I think total return is the other word that comes to mind.
Okay, Tom?
Yeah, I think the first word I'd think of is probably consolidation. I think both in terms of the underlying markets as well as potentially the players in the market. So I think we're probably going to go through an period of consolidation. I think, I like the word sustainability. It also came to my mind, and I think maybe linked to that is endurance, because I think this is not a one-day game. As we all know, this is going to take time to, for the market to grow and eventually start attracting the international capital, when it gets to that size that we feel is deserved. I think that also links into the structure of funds, by the way. We've traditionally seen these sort of 8-10-year PE-styled funds. I think, a lot of people are rethinking their strategies in that, and I think, there's a much stronger move towards permanent capital vehicles entering the space. So that's a fundamental change. And the last one I'd like to end on probably is the word growth, because I think, we do believe, over the next sort of 10 years or so, we are going to see a growth story. We are in a continent that is growing, adjacent to Southeast Asia, the fastest growing region in the world, and I think that will continue. But I think one has to pick your spots. You need to, understand your asset class and be patient.
I think three words, I guess. Think of the markets as a portfolio, different dynamics, but and you might have a bit of pressure here, a bit of growth there, but you sort of use the balance of the different markets to drive that growth. You've got to look at domestic capital formulation or capital sort of aggregation. That has to drive the market going forward. And I think maybe on that point, I'll have 2 words.
All right, excellent. Well, thanks very much to the panel. I think we'll leave it there. Kefir, if that sounds right to you. And just remains for me to say thank you very much to the panelists for the effort and time you've put into making your points clear. Thank you.